Well, good morning, everybody, and thanks again for coming out to the Southeast Fintech Conference. I think we have a great panel, as Dan said. We really represent these gentlemen represent the capital continuum, so everything from angel investing, Series A and Series B. So this is really gonna be a perspective from the investor. But let's go ahead and start off, and let's do introductions. If you can tell me a little bit about yourself, about your fund, if you have any fintech investments, talk a little bit about that, but love to hear. So we're going to start at the beginning with angel investing and Greg Brown.
Hi, I'm Greg Brown. I'm the administrator of a group called Charlotte Angel Fund, which is a group of 70 men and women, largely but not exclusively residents of Charlotte or the general Charlotte area. We make we're angel investors. We'll participate in what you would think of as angel seed, and then maybe continuing on into some participation in Series A if we have that opportunity. We're normally, I'd say, a $200,000 investor in a $500,000 to $2 million round. Fintech is within the scope of our fund, but we're not exclusively a fintech investor.
Gardiner?
So I'm Gardiner Garrard, and I'm with TTV Capital down in Atlanta, Georgia. I started the firm with a partner in 2000, and all we've ever done is fintech investing. I grew up in Columbus, Georgia. I didn't know if you could make money unless you're in financial services. It was Aflac and Synovus Financial Corp and TSYS, and so when I got into the venture space, it was just the industry that I knew, and that's all we've done. I think we've probably funded 50 fintech companies in that time. We've invested about $200 million.
Great.
Hi, Luke Timberlake with Fintech Ventures. We're relatively new to the block, been doing this about 2 years. I am based in New York and spend a great deal of time in Atlanta. And we have 2 companies actually in the southeast of the 6 that we've invested in, and we really do 1 to 10 million seed to Series B, primarily lending, payments, and insurtech.
Great. Well, guys, let's go ahead and jump right in. Let's start with the state of the union, so to say, of fintech in the Southeast. What have you seen over the past years? What trends do you see? Just how have things changed in the last couple of years? I'm going to start with you, Gardiner.
It's a big question. I don't want to set precedent. It's going to take me a couple minutes to answer this one, though. So then, I read a book about 6, 7 years ago called Technological Revolutions in Financial Capital, and it explained so much to me about what the opportunity is in the Southeast. And the punchline is, I think we're in the golden age for fintech investing in the Southeast. And in this book, it's an economist and this lady named Carlotta Perez, and she kind of breaks down technology revolutions and the flow of funds and investment returns and wealth creation. And the punchline is, you can break almost all of these cycles, these revolutions, down in kind of these 60-year periods, whether it was the Industrial Revolution or the transportation or the digital age we're in today. And in the first half, so call it 1971 to 2000, you get the creation of a whole new industry. So we got the technology industry created during that time. The wealth creation is very geographically concentrated, think Silicon Valley or Boston, and you get new technology or new infrastructure into the society. So we get wireless, we get satellites, we got cell towers and so forth. But the second half, which she calls the deployment period, which they started in 2001, that's where the most money gets made. And it's in that time that all the other industries that predated the creation of the new industry, so financial services or retail or manufacturing or healthcare, those industries begin to get modernized and disrupted by people that build, like us and people in this room, that build applications on top of that technology. And we use words like cloud and big data and mobile, but what we're doing is building business applications on top of that technology. So despite the fact that the wealth creation is very concentrated in that first half of those cycles, in the second half it goes much more globally dispersed. And the wealth creation ends up occurring more around the areas where people have business intelligence around the industries that are being disrupted. So when you look at the Southeast, and particularly at Charlotte, you would think it's very logical to see a lot of the wealth creation coming around banking and financial services. And all those industries don't just transform at the same time. I think 2000, 2010, we had media, entertainment, and advertising. You had Netflix and Facebook and Twitter and Google and so forth. And starting with the financial crisis, I think the eyes of the world turned to financial services. And financial services according to JP Morgan, is about a $25 trillion a year industry. That whole social media craze was about a $1 trillion industry, media, entertainment, and advertising. So I think we're right in the second or third inning of kind of what's going to be the golden age for fintech investing. And I think it's places like Charlotte are very well positioned to capitalize on that.
Luke or Greg?
Yeah, I'd echo that for sure. I think in a lot of industries too, if you look at online lending, where we kind of spend most of our time, you're 10 years into it and you're kind of seeing, for better or for worse, natural consolidation. I mean, I think that's always been, in the payments when it comes to M&A and things like that. So I would echo that, generally speaking, I think we're in a golden time where all the right things are moving in the right direction. I'd say in the Southeast, and I've, only been doing this for about 2 years within Atlanta and, spending some time in Charlotte, I think we're just at the beginning. And it's people like the stakeholders in terms of the accelerators and the mayors of these cities. I think they've just started to take note, and it's been around for a while, but I think we're getting started in terms of everything that's been going on. It's only been really the last 5 years, and I don't think we've seen everything in terms of the cycles that Gardeners talk about fully flesh out in the Southeast at all. I think we're just getting started when it comes to the state of the Southeast of fintech. And so again, I think it's a great time, and more events like this will help foster that kind of spirit.
So Gardiner, you talked a little bit about Charlotte and its natural with banking and the community we have here. Are there other hubs, so to say, in the Southeast that are ripe for fintech investments that you've seen in your travels, and this is to everybody, that you've seen in your travels as far as some really interesting fintech companies coming out of those markets?
I'm a little biased because I live in Atlanta, but we have a really nice hub, largely thanks to North Carolina in a lot of ways, because you guys had some pretty progressive state county-to-county branch banking laws, and we had some very restrictive banking laws due to the fact that Atlanta had about half the population. All the cities like Columbus, LaGrange, and Savannah wouldn't allow banks in Atlanta to bank in their markets. And so as you guys learn to scale with technology and build banks like ultimately Bank of America or Wachovia, First Union, BB&T, and so forth, I'm sure I'm leaving some out, but you guys came in and bought all our banks in Georgia. And the only ones you didn't buy were Synovus, which had a payment processor called TSYS, and then SunTrust, which had, 50 million shares of Coca-Cola stock. So the PEs just didn't work. And so when you bought all those banks, you stripped out all the operations folks, all the tech folks that did the risk management, ACH, compliance. And so Atlanta got left with a lot of IT talent. Almost all of the fintech talent that you have in the industry has come out of the banking industry. It started inside the banks. People learned how to do these things inside the banks. My partner, Mark Johnson, was one of the co-founders of CheckFree. He worked for Bank One. They were in Columbus, Ohio when they started CheckFree. As they began to grow, they realized there was all these ACH talented folks that used to work at banks in Atlanta that now had moved to Charlotte, where you really, those jobs were gone. And so those folks in Atlanta. So the other thing Atlanta has is payment processing. We process about 70% of the world's credit, debit, and prepaid cards. So, I just invested in a company in London, and they think that the worldwide headquarters for payments is Atlanta, and all their clients are TSYS and Global Payments and WorldPay, and so they're right from where their revenues are coming from. In fact, that company has an office here. They do business with Ally Bank, and I think that's a real asset for you guys, Ally Bank. They're very progressive and like to partner with entrepreneurs, from what I can tell. Anyway, Atlanta.
So you mentioned payments processing in Atlanta. What are some of the hot sub-industries right now? So you hear cryptocurrencies. Guys,
you go ahead.
Yeah, I would say probably the most frequent thing that I see is an app of some sort to try and help millennials save money, right? Either save more money, pay down their debt, but a lot of it trying to get to the idea of financial management for that particular generation. I would put that at the top in terms of what I see most frequently.
I would see an app to save millennials with AI, the most common.
Yeah, blockchain behind it.
In all seriousness, I think people are still, in my mind, figuring out how to use what they call artificial intelligence in banking, whether it's integrations with Alexa to pay your bills online, and I think we're just at the infancy of that point, and I think people are developing this technology, and eventually they'll figure out ways to utilize it to save everyone time and money. So I think for me, it's, AI is a buzzword, but people are definitely using it, and you kind of go to Finovate in these conferences, and the two main themes you see are people going from B2C platforms in terms of selling to millennials to help them save money, to go directly to selling to banks and financial institutions. And then you also see people trying to use some sort of intelligence to make smarter decisions about their money or save people time and money dealing with their online or banking activities. So those are kind of the two areas that I've seen in terms of how
So Greg, I sit with you on Charlotte Angel Fund, and we've certainly seen pitches about blockchain, cryptocurrencies. Do you all have any opinions on those? Are these real investments? Have you all made investments in that space?
We have, but you want Greg to answer first? We can get stuck on this one all day.
Yeah. This could be fun. Separate panel. So we have seen, sort of, I would say, moving down the continuum, right? We've certainly seen blockchain-themed companies, all the way from that to companies that just seem to throw it in as a buzzword, right? And, but we're blockchain, but it's not, it doesn't seem to be essential to what they're doing. We haven't seen anything that I can think of in the way of cryptocurrency. And I think that would be, for our group, and I think for most angel investors, so we're generalists, right? We're not specific to any one particular sector. And I would, so if you think of who the members of Charlotte Angel Fund might be, not surprising, a lot of them come out of the financial services industry. And those folks, I think, are going to have a hard time getting, as generalists, comfortable with, for example, some sort of cryptocurrency deal that is just a paradigm that they're not currently living in, and they haven't put any sort of inordinate or special research into.
I just add that I think we're a little early in that cycle too. So if you look at trying to make an investment as a VC and you have 5 to 7 years to get out of that, a lot of these blockchain kind of Bitcoin cryptocurrency investors, if you look at some of the other people I've talked to in the space that made these investments 7, 10 years ago at the forefront of the wave, there's no real viable exit yet. So whether or not you agree with the technology, looking at it from the investor's chair, I don't really like the space because I don't think there's enough commercially viable acquirers, such as payments companies, stock exchanges. I don't think they're going to look at these types of assets yet. So whether or not you like the technology, I don't really like the space from investment. And then we're not even talking about, I think the regulatory landscape's a little bit kind of soft at this point. We don't really know what people besides China are going to take stances on in terms of ICOs, et cetera, and I think that's also a risk from an investment standpoint as well.
So, go ahead and just answer, because we're in this space. I mean, we've invested in a company called BitPay in Atlanta, and think what a merchant acquirer is. That's what BitPay is. They sign up merchants, enable them to take Bitcoins. I think those types of investments right now, facilitators that are part of the infrastructure that really don't hinge themselves to the fluctuation on the currencies are good bets. But my overall assessment, in short, is I think it's kind of like 1998, and if you slap .com on the back of a name of anything, then you were raising money, and that's what's happening with ICOs right now. ICOs are not currencies. They're tokens that enable you to do business with a startup. They're startup companies. They've built tokens into their model. Forget Bitcoin for a second. Bitcoin is the purest of all of them. They're really just trying to be a decentralized monetary policy. But I will tell you this, the trends, when you talk about tech trends and the guys that are the nerds, they're spending their weekends on blockchain. And they genuinely believe you've got microprocessor, PC, internet, mobile, blockchain. I mean, they think it's the next big tech wave, and it really is just a database. It happens to be a public database, a distributed database. It's got some advantages, and I think, yes, it's 1997 in the internet. Had you invested in a .com then, you probably got hammered, but if you look at how much money's been made on top of building applications using the internet since then, it's pretty significant. And so I wouldn't turn your back on blockchain, but I don't know that right now is necessarily when I would jump in. I think we're in a bubble. We're in a frenzy around it.
So we're talking about blockchain, cryptocurrencies kind of in their infancy. How about where are the acquisitions, where are the exits happening now? So sticking with the theme of submarkets, are there a lot of payments companies, for example, in Atlanta that are seeing exits? Where else are you seeing exits?
Well, payment companies are pretty easy to exit just because there's a lot of potential acquirers. There are a lot of people, I mean, from Amazon to Facebook to TSYS to First Data to Bank of America that are interested in payments. It's a pretty ubiquitous application that everybody needs. What we're seeing in payments today is, I hesitate to say this, it's a seller's market though. I mean, this is probably the highest multiples I've ever seen in companies selling payment processors. Just look at Square. I mean, look at their multiple and the value. They just surpassed First Data in valuation, which is, a big deal. And, it's kind of one of those ones I missed. But, their first three models were terrible. But Dorsey, just like a Bezos or something, he can just keep raising money even when things aren't working. And what he's on now, this register product, is a real product. It's a good product.
Let's switch the perspective to the entrepreneur. So we obviously have some entrepreneurs in the audience today. So again, the capital continuum here. I'm going to start with you, Greg. What are reasonable expectations and asks of companies at different levels of funding? Let's start at angel investing.
Angel investing, reasonable. You're talking about a $500,000 to $1 million raise is probably where you're at. You're probably looking at, anywhere from $2.5 to $5 million pre-money in those deals, depending upon, attributes of the team and how much progress they've made to date, et cetera. But I think that those asks would fall sort of in the middle of the bell curve in terms of what angel investors would usually see.
Series A, Gardiner?
Yes, Series A, it tends to be $3 to $5 million rounds, and companies tend to have, if it's recurring revenue, maybe it's only $50,000 but a month, but usually about $100,000 a month in revenue you would like to see. There's people you can call and ask about the product and how it works. But you're raising capital to try to prove out an investment thesis on your sales and growth. Valuations range about 10 to 20 million, I think, is kind of on average.
Okay, and over to Series B and Luke.
Yeah, I mean, it becomes more of a free-for-all, but I'd say, leaving off where Gardiner left off and a little bit higher, I mean, in all seriousness, it's probably about anywhere from 5 to 15 and kind of pre-money, let's say 20 plus. But again, it gets very difficult at the Series B because most companies don't really make it that far. They either could hit profitability, they go out of business more likely, and it becomes a lot different too because you have more VCs that are doing smaller checks, and then you have growth equity folks that are coming in and kind of writing larger checks at higher valuations. And once you kind of hit that B level, you can kind of go in a variety of different paths. It's a little bit more tricky, but I'll leave it at that.
Just to throw in, because that's such generic feedback to the entrepreneur, if you're really in the room, first off, every situation's unique. Second, I'd do everything you can before you take money from any of us. I mean, just grow it as organically, learn how to be an efficient business, be resourceful. A lot of times money can actually be a hindrance because then you get a little bit lazy on how you solve problems and you just spend money thinking I'll add a resource. And so what we like as investors is when we see that creativity and resourcefulness and that entrepreneurial spirit where somebody comes in, they've done a lot with a little, they're not looking to raise a lot of money. And then that really flows through all the way up the continuum. I mean, if you get up to doing a B and you've raised just a couple $1 million or something, but you're up to 5, 6, 7 million in revenues, you're going to get an attractive valuation, and you're going to have a lot of people that want to invest in your company. The early stages are just this hard, but if it were easy, everybody would do it. And I don't mean that to sound flippant, because what you guys do is a hell of a lot harder than what we do. I mean, we're like movie critics, and you guys are out writing scripts with a blank sheet of paper and then hiring people and acting and directing, and so it's hard work. But what I know we respect is when we see people that have really been resourceful with how they've gone about building their business and even if it takes a little bit of time. What will kill you faster than anything is an upside-down cap table with we've raised a lot of money and you've wasted it. You'll never get to your B round or even the A round.
Yeah.
I just add that I would think about it more of not the amount of money you're raising, but probably what % of the company you're giving up at each stage, and look at it that way. It goes back to Gardner's point that, yeah, try to avoid raising money from us will probably make your life more difficult at the end of the day if things are going poorly. But no, in all seriousness, I think I would look at it that way, and I would also look at it as not getting hung up on the valuation. I think that's another thing, that it's easier to raise money at a lower valuation that you've grown into versus coming out and not matching your valuation and then having to go raise $5 to $8 million with a company where the revenue doesn't really add up to the expected kind of value of the company. So I would kind of look at it that way, more of how much control you're giving up of your company on the other side of the table versus, the amount of money that you're necessarily looking to raise.
I'd love to touch on a point that Gardner raised, and that's about capital efficiency. So I sit in Charlotte, and in the fintech space in Charlotte, it's not unusual to see somebody who's coming out of a, let's say, 20-year career in the financial services industry. They recognize a problem, so they're going to go attack that. And sometimes, sometimes they have the burden of having too much capital available to them, depending upon what their career path has been. And so that enables them to spend, a couple $1,000,000 of their own money and their friends' money in friends and family to, before they've even got product to market, right? Because they have the luxury of spending that money. And so then they're, they've spent $2 million, and so they're coming to an angel group because now, they don't want to spend any more of their own money, but they haven't yet developed customer traction or anything, and now they want to be at $8 million pre-money, right? And it's because they've spent $2 million, not because of what they've accomplished in the marketplace. And so that it's that capital availability that sort of enables inefficiency that can be a problem. So one thing I think, for fintech entrepreneurs, if you come out of, let's say the financial services sector, surround yourself with people who've been in startups before and listen to them, right? Who've had the experience that you haven't had, to say, because inside the bank, you probably never started anything for less than $10 million, right? And so $2 million seems like a pittance to be able to get to market. Listen to people who will talk about, look, you're going to get yourself all jammed up on your cap table if you spend too much money early on.
Yep.
I'm going to put you guys on the spot a little bit again from the viewpoint of the entrepreneur. If I am raising capital and I'm vetting VCs, what questions should the entrepreneur ask you? And Luke, can I start with you? Because I think that's an easier question in the later stage. As you said, if you're raising a Series B, hopefully you have a lot of options as far as investors go. What should we ask you?
Yeah, so I was actually at an accelerator the other month, and they had, and I think they trained them to do it, and I think it was a very good question, but a lot of people don't ask this because they don't, I guess, want to, it's an abrasive question, but I like it. But I'd say, what value do you bring to me as on the table? Because it's a mutual relationship. Just because I am providing money to you does not mean that, you don't get anything in return. And so I would really spend a lot of time doing that. And then if you get any further, actually asking for references and to speak to the portfolio companies of the existing VC, because it's not going to be for everyone, just like every idea is not a fit for every VC. And so really thinking about it in terms of relationship, and even doing your homework at the early stage in terms of, doing general reference checks, I think is very important. So I would look at it that way and really see what value they're going to bring to you and go from there.
Gardner, any thoughts on the Series A side? Or
That's the
echo
two I
those?
would have said. We
Okay.
talked to other entrepreneurs where we've sat on the board, and then the value that you can add.
Yeah. I think in the angel space, it's a completely different animal, right? You've got organized groups, you've got individuals, so it's harder to sort of, but I think it's, some questions I'd be asking are, what are the last 3 investments that you made, right? When did those occur? And so get a, Are you a check writer, or are you a consultant / services provider wearing the cloak of being a check writer, right? And that's going to be when you're talking with an individual. If you're talking with a group, it's a little more straightforward. But the angel world is far from homogenous, right? So you deal with all sorts of different people. But I think figuring out really quickly, is this somebody who might fund my business? Do they have capital available to fund? What are they really looking for? And don't be shy about asking those questions, right? Because if you ask those hard questions, the worst thing all right, so it ends up, the conversation ends and you can use your time more efficiently, right? Or at least understand exactly what it is, as opposed to spending 90 days in dialogue before you find out that this person never writes a check, right? They just want to sell you services or do work for equity or whatever it is.
That'll be the one last question I was asked too, is ask the VC, tell me about what you've done when things have gone wrong with one of your portfolio companies, or how have you helped them out of a tough time, because I think that's important. Sometimes, we do have to cut our losses, but other times we'll step in and, get our hands dirty and go work for the company directly. So really understand if they're willing to go to bat to you when things go poorly. Because like I said, I think that's more important in terms of your relationship with the VC. When things are going well and you're generally hitting your numbers, there's, not too much to talk about at board meetings, generally speaking.
One other thing, I'm just doing the inverse of what we do here, but follow-on investments that you are counting on, yet when we invest in Series A, we'll have reserves, and we generally talk to the entrepreneur about what needs to occur from a milestone point of view for us to put in additional capital, just to avoid when things aren't going well and we're not giving you any more money and everybody's mad, we just kind of do it on the front end. So I would just flip that around to you. I would ask, particularly a Series A investor, what milestones do we need to hit as an organization to where you're going to follow in and participate in the next round?
So I want to leave a few minutes for questions from the audience, but last question for you guys. Just want to talk about the future. So Southeast Fintech investing, where are we going in the future? What do you see in the markets that are represented here today? Any thoughts?
I kind of touched on it. I think we're in good shape just because of the leaders we have in the incumbent kind of ecosystem. One thing that's happened in the last 5 years ago when fintech started to get a buzz, most of Silicon Valley companies and other entrepreneurs were all about, I'm going to kill the banks, existing banks, and they're not smart, and they don't know what they're doing. And then they started trying to set up their own compliance and security and regulatory and realized cost of funds are a little higher than they thought. And now what's come full circle probably in the last 12 months is almost all the entrepreneurs that are getting things started or have an angle towards partnering with a lot of the incumbents. So with Atlanta and Charlotte, just between us, we have a very large percentage of the leaders in the existing financial services world with real distribution out to customers that can use these products and services. So I think we're in as good a shape as we've ever been. Not to mention the other things, the geographic, the weather, the cost, the talent, that kind of stuff.
Yeah, and I think that this relates to fintech, but isn't fintech specific. I think that, so entrepreneurial ecosystems, there's a certain evolutionary pace of development. I think that for the Southeast, because of quality of life and desirability in terms of place to live, and the people that are coming to the Southeast tend to be high quality, have high quality individuals. I think that is going to allow the Southeast and specifically the entrepreneurial communities in the Southeast to grow at faster than evolutionary pace, right? So I think I'm bullish on Charlotte and the Southeast for that reason.
And Luke, you spend a lot of your time in New York City, so compare and contrast. So where do you see the advantages for us and where we're going in the future? And when I say us, the Southeast.
Yeah, I just kind of echo first off that I think we're just getting started in terms of what's going on. If you look at Venture Atlanta, for instance, which is a conference that I think a lot of you were at, and it's kind of the Southeast General Conference, not necessarily fintech focus, but the first time in 10 years that they've done the conference, there's more investors than there were entrepreneurs. So I think that kind of shows that people are showing up, and there's only kind of 30 to 40 of them you probably see from the Southeast, and the rest were, or let's say Atlanta, and the rest were coming from out of town. So I think we are just getting started when it comes to the general ecosystem. I mean, in terms of New York versus Atlanta versus Charlotte, I think a lot of people are choosing to locate their companies here, and you know, the funding ecosystem doesn't exist yet to the point where you probably can only raise money within the Southeast. But because of, you know, let's say the airports, whether it's Atlanta and you're basically within, you know, 70, 80% of the country within 2 hours, or, you know, Charlotte as well, you can still go to these other cities to raise money. So I think if anything, through osmosis, as, you know, Gardiner and everyone else has been saying, I think it just starts to kind of come down here, and we develop kind of more of a community that kind of doesn't really have any boundaries of north versus south, and I think it's already really starting to happen, and it's partially the people coming, you know, from New York and spending time in the Southeast, and that's how it begins.
Yep. One other thing I would add real quick, I mean, I get the competitive nature. I was on the Board of Economic Development for the state of Georgia for 8 years, and so we were banging heads with you guys all the time, but this isn't a zero-sum game, this entrepreneurial activity around Fintech. I mean, a rising tide is kind of the way I would think about it. So if New York does well, great. And it's good for Charlotte, it's good for Atlanta. The more success we see around Fintech, the better we all are, because it'll build a culture and a desire amongst your community where people will want to support that type of business and those types of investments. And that's what you need, really, and time.
Let's open it up to the audience. Questions for our panelists?
And hopefully use the mic so the video gets it, please.
Sure. So fun topic, exit. So if you, let's say you're, you know, a startup player disrupting a space that has larger, deep-pocketed corporations in it, and you start to get the sense, maybe not a firm LOI, but you start to get the sense that they're ready to sort of take you out. What would you say from the day you discover that would be like sort of the tactical next steps to protect yourself, to maximize exit amount, you know, to do it in a timely manner, to preserve IP in case it doesn't work out, et cetera, et cetera?
Well, I can speak to it from a kind of behavioral point of view, and that it's a little bit, it's an art. It's not a science as it relates to when you're really trying to optimize your valuation. Now, I won't speak to the legal protections components. I would hire a lawyer at some point and a banker. But I think the trick is to build that relationship and figure out how to get them to ask you out. You know, and so it's a bit of an art. You don't want to seem desperate or that you really need anything, but you want to stay in the tent and have a relationship. Ideally, you'd have some kind of commercial agreement where you were doing business together already, and that was a way to build that. But to the extent you can get someone to make an offer or at least put something in writing, and then that's to me the most successful processes I've ever seen on exiting, where there's somebody, an external force that initiates an offer, and then from there, it gives you confidence and credibility to probably talk to some other folks and see if you can't generate interest. The just waking up one morning and saying I want to sell the company and then hiring somebody and going through an auction process has got a lot of risk. It's unfortunate. It's just kind of the nature of it. I've seen some work out. I don't mean it's impossible. So.
Other questions?
Yeah, I know you guys spend a lot of time talking about payments and blockchain, cryptocurrency, that kind of thing, but what areas of fintech would you say are currently overlooked?
Overlooked.
I'd say insurance is still overlooked, let's call it, and it's a very broad space, but you know, reg tech as well. I mean, these are kind of buzzwords, but if you look at it in terms of the investment and how long these industries have been along, I think those are two areas that have been overlooked but are starting to get a little bit more excitement and kind of investors looking at them more closely.
I think we have time for one or two more.
Sure.
I think I saw a hand go up over here.
Had to be Dan all the way across the room, right?
Yeah.
curious what your guys' opinions on, we talked a little bit about valuations. I'm an angel investor, and there does seem to be a disparity between, say, the South and the West Coast and Boston. Do you see that coming together, or do we in the Southeast enjoy lower valuations for for similar companies?
I hope it's the latter. I mean, it's silliness. I don't know if y'all watch the show Silicon Valley, but like 95% of it is true almost when I go out there. We do a lot in California, and yeah, they just start at a higher number, and I don't get it. But hopefully the globalization doesn't hit us too quickly on that.
Yeah,
go ahead.
I would concur. It's just sort of, it's pretty simple for the investor, right? We're just doing a math equation to figure out if we can make money on this in the end. And the exit price is pretty much going to be the same whether you're based in Georgia or in California, right? So, if you're staring at 8 million pre-money as an angel investor versus 3, that's difficult, right? And it goes all the way up the chain through all the VC rounds.
Yeah.
Yeah.
I think it's a cultural thing. It's like if you had a couple of winners here, and all of a sudden you had a Square that came out of here, and you had a $10 billion market cap, your angel pricing is going to go up because there's just how many people like yourselves are willing to do it. Right now, what the Southeast suffers from in some ways, but we benefit from as investors, is just the demand. And that's all that's driving these cryptos. There's no real investment principle behind it. There's just a culture there's a high degree of demand, and it's driving the prices up. And that's what goes on in Silicon Valley. There's just, for a hot entrepreneur who's got a hot idea, there's a lot of people lined up to want to invest, and he or she can, and it's a seller's market.
I would say in New York and Atlanta, Boston, they're pretty similar at the earlier stage.
That's right. I agree with that.
I mean, the difference comes later on, and it's just partially because no two companies are the same.
Do we have time for one more, Dan? Yes.
Thank you. Question about, in fintech in general, which investment business model kind of interests you more? Companies that are trying to displace traditional banking, or those that are trying to partner and collaborate with traditional banks?
Well, I'm partial to the latter, and a lot of those traditional, not necessarily banks, thanks to Dodd-Frank Volcker. It used to be a lot of banks for me, but now I can't have them as illegal for them to invest in ventures. So, but we're partial to partnering with the incumbents and doing business with them, either through vendor relationships, sometimes them as customers, and sometimes distribution. I think there's a lot of elements to banking that it's not really advantageous for an entrepreneur to try to take those things on. The wheel's already been invented, and there's just no reason for them to try to do what somebody else can do for a whole lot less money. But that's my bias.
If anything, banks are trying to become technology companies. I mean, if you look at kind of what Goldman Sachs and a few others have done, where they've long shunned or competed with the online lending industry, but now because they have the lower cost of capital, they realize it's attractive, and things have fleshed out over 10 years. They're building their own online bank and leveraging that and trying to compete. So I think it's almost become the opposite in certain regards, that banks are innovating using technology to compete or partner with other fintechs.
I mean, forever, fintech was innovation on operations of the financial institutions, and what has transpired in the last 5 years is entrepreneurs are innovating towards the customer, the marketing, the sales side. And that's what woke all the financial institutions up. They're like, holy hell, they're not just selling to me now they're going after my customers. And so initially there was we're going to take over your customers. And what they forgot about was the complexity of the operations. And so most of the firms, and you should talk to Rob Frohline, who's here later today, Cabbage, ask him the same question. I think they are more and more moving towards selling their marketing technology, this first class, world class, and enabling banks to use that to acquire customers for themselves and run on their own balance sheet.
Well, gentlemen, thanks. Very insightful, great panel to start off the day. I'll bring up Dan. I think we're going to move to a break now.
Yeah, it's still on. Good. how about a big round of applause for our panelists? Thank you all, gentlemen, very much.